The foreign exchange Forex market, often simply called Forex or FX, is the world's largest financial market, where global currencies are traded 24 hours a day. In fact, Forex trading volumes reached an all-time high of around $9.6 trillion per day in April 2025, reflecting how massive and liquid this market has become. But what exactly does that mean for a beginner? In simple terms, Forex trading involves exchanging one currency for another in the hopes of profiting from changes in their exchange rates. Unlike stock markets that have a central exchange and set hours, the Forex market operates across the globe in multiple sessions, allowing trading virtually around the clock during weekdays. This constant activity makes Forex exciting, but it also requires understanding some unique concepts and risks. In this comprehensive beginner's guide, we'll explain the fundamentals of Forex trading in clear language, from what currency pairs are, to key terms like pips and lots, to more advanced concepts like leverage, margin calls, slippage, and swap rates. We'll use real-world analogies, without the hype, to make things easy to grasp. Whether you're completely new or have dabbled a bit, by the end of this guide, you should have a solid foundation in how Forex works and what to watch out for in 2025's Forex landscape. Let's dive in. The Forex market is a decentralized global marketplace where currencies are traded in pairs. There is no single physical exchange. Trades occur electronically through banks, brokers, and financial institutions across major financial centers: London, New York, Tokyo, Sydney, etc. Because of different time zones, the market seamlessly transitions from one major session to the next, operating 24 hours a day, 5 days a week, closed on weekends. For example, when trading closes in New York, it's already morning in Tokyo and Sydney, so trading continues. The graphic above illustrates the main trading sessions in GMT. As the Sydney Asian session ends, the European London session picks up, followed by the US New York session, providing nearly continuous market hours. This around-the-clock schedule means Forex traders can react in real time to news and global events. It also means liquidity, the ease of buying, selling, without drastically moving prices, is generally high during peak session overlaps. For instance, when London and New York sessions overlap. High liquidity tends to keep trading costs, spreads low, and execution fast. On the flip side, during off-peak hours, late US session transitioning to Asia, market movement can slow and spreads may widen, which is something to be aware of as a trader. Who participates in the Forex market? It's a diverse mix. Major banks and financial institutions, which do the bulk of volume for things like international trade and investment; central banks, influencing or implementing monetary policy; corporations, hedging currency exposure from business operations; and individual retail traders like you. Thanks to online broker platforms, retail participation has grown significantly. By 2025, tens of millions of individuals around the world trade currencies online, often with small accounts, contributing to the market's immense daily turnover. It's truly a global market, and currencies reflect the health of their respective economies, making Forex trading an interesting way to speculate on world events, but also a complex one that requires learning and prudence. Market size and importance. As noted, Forex is by far the largest financial market. For perspective, its daily volume, nearly $10 trillion in 2025, dwarfs that of stock and bond markets. This depth makes it attractive. There are always buyers and sellers for major currencies. It also means prices can move quickly when big news hits, like central bank announcements or geopolitical events. Currencies respond to factors like interest rates, inflation, economic data, and investor sentiment. For example, an unexpected interest rate hike by the U.S. Federal Reserve might strengthen the U.S. dollar, causing USD exchange rates to rise against other currencies. We'll discuss specific examples later, But the key takeaway is Forex is huge, fast-paced, and influenced by a wide range of economic forces. Forex trading always involves two currencies. Unlike, say, buying a stock, where you exchange cash for a share of a company, in Forex you are simultaneously buying one currency and selling another. Currencies are quoted in pairs, such as EUR just USD, Euro versus US dollar, or USD JPY, US dollar versus Japanese yen. The first currency is called the base currency, and the second is the quote or counter currency. The quote you see, for example, EUR USD EURs 1000, represents the price of 1 unit of the base currency in terms of the quote currency. In this case, €1 is equal to 1,000 US dollars. Essentially, the exchange rate tells you how much of currency B you need to buy 1 unit of currency A. Think of it like traveling. Imagine you live in Europe and go to the US. You might exchange euros for US dollars at a bank. If the rate is 1 EUR or 110 USD, giving the bank $100 would get you 110. Now, if you come back later when the rate is 1 EUR, ARCshores 1.20 USD, exchanging $120 back might yield $100, ignoring fees. If rates moved in your favor, you could even profit from the exchange. Forex trading applies the same idea, but done speculatively through online platforms. You don't physically hold cash. Instead, you trade currency contracts that fluctuate with exchange rates. Importantly, currency quotes are typically given with bid and ask prices, similar to other financial instruments. The bid is the price at which the market, or your broker, will buy the base currency from you, and you sell at this price, while the ask, or offer, is the price at which the market will sell the base currency to you. You buy at this price. The ask is always slightly higher than the bid. The difference between them is called the spread, which is essentially a transaction cost and the broker's commission. We'll cover this shortly. For example, if EUR USD is quoted 1.1000, bid, 1.1003, ask, the spread is 0.003, 3 pips. More on pips next. You would buy at 1.1003 and sell at 1.1000, meaning you'd need the market to move at least 3 pips in your favor to break even on that trade. Long versus short. In Forex, you can go long, buy a currency pair, or go short, sell a currency pair. Going long EUR USD means you are buying euros and simultaneously selling dollars. You expect the euro to strengthen against the dollar or the dollar to weaken. If the price rises, you can sell back at a higher rate and profit. Going short EUR USD means you are selling euros and buying dollars, expecting the euro to fall versus the dollar. In Forex, going short is just as common and as straightforward as going long. You're always exchanging one currency for another, so there's no concept of borrowing shares as in stock short selling. This two-sided nature of Forex, the ability to profit from both currency strength and weakness, is a key feature that attracts traders. Before diving into terminology, one more point. Forex trading is typically done on margin with leverage, explained later, so you don't need to put up the full value of the position. This makes it accessible to individuals with small capital, but it also amplifies risk. A small price movement can mean significant gain or loss relative to your initial deposit. Hence, understanding the terms and risk management is crucial for beginners. Let's explain some must-know Forex terms in plain language. These are the building blocks of understanding FX trades. Currency pairs and quotes. We already covered this, but to reinforce, currencies always trade in pairs, e.g., EUR USD, USD, JPY, GBP, UAH, etc. The exchange rate is how much of the second currency equals 1 unit of the first. Major pairs are those involving the US dollar and another major economy, EUR, USD, GBP, USD, USD, JPY, etc., and they usually have the tightest spreads and highest liquidity. Minor pairs, crosses, don't involve USD, e.g., EUR, GBP, AUD, JPY, and may have slightly wider spreads. Exotic pairs involve a major currency and an emerging or smaller economy's currency, e.g. USD TRY for US dollar versus Turkish lira. These can have low liquidity and high volatility spreads, so beginners beware. Pips. A pip is the standard unit to measure how much a currency pair's price moves. It stands for percentage in point or price interest point. For most currency pairs, 1 pip, ersier 0.1, i.e., 1/10,000th of the quoted price. For pairs involving the Japanese yen, which are usually quoted to 2 decimal places, 1 pip, 0.01. So if EUR to USD moves from 1.1050 to 1.1051, that 0.001 rises 1 pip. If USD JPY moves from 150 ZORs to 150.05, that 0.05 move is 5 pips. Pips let traders discuss price changes in a standardized way. Often you'll hear things like, I made 50 pips on that trade, or the euro fell 100 pips today. It quantifies movement regardless of the currency's actual price. Some brokers also quote fractional pips, pipettes, an extra decimal place, e.g. 1/503, where the last digit is 1/10 of a pip. But for beginners, regular pips are what to focus on. Lot size. Unlike buying one share of stock, in Forex, trades are conducted in lot sizes, which are standardized units of the base currency. A standard lot is 100,000 units of the base currency. A mini lot is 10,000 units, and a micro lot is 1,000 units. Some brokers even offer nano lots, 100 units, for practice. Don't be alarmed by these big numbers. You won't necessarily need $100,000 to trade a standard lot because of leverage, explained soon. But it's vital to know the scale. If you place a one-lot trade on EUR USD, you're effectively controlling $100,000. The pip value, how much money one pip movement gains or loses for you, depends on the lot size. For a standard lot on most pairs, 1 pip pars $10 in the quote currency, under typical conditions. For a mini lot, 1 pip $1. For a micro lot, 1 pip $0.10. So if you made 50 pips on a trade with one standard lot, that's about $500 profit. If you lost 50 pips on a 0.1 lot, mini trade, that's about $50 loss. Choosing lot size is part of risk management. Larger lot, more money at stake per pip. Beginners are strongly advised to start with micro or mini lots until they're comfortable. Spread. As mentioned, this is the difference between the buying price, ask, and selling price, bid, at any given moment. If EUR USD is 1.2050, 1.2052, the spread is 0.0022 pips. Spreads are effectively a cost to the trader. When you open a trade, you start with a small negative because if you immediately closed it, you do so at the slightly worse opposite price. Tight spreads, say 1-2 pips on major pairs, are advantageous, as they make it easier to profit from small moves. Spreads vary by pair and by market conditions. Majors have the lowest spreads. Exotics can have much higher spreads. Also, during volatile news or very low liquidity times, spreads can widen temporarily. Brokers either charge via spread markup or via commission plus raw spread. As a beginner, focus on brokers with consistent tight spreads on the pairs you want to trade. Leverage. Leverage is one of the defining features of Forex trading. It means using borrowed funds to control a larger position than your cash alone could cover. In Forex, leverage is commonly provided by brokers at ratios like 50.1, 100.1, 500.1, etc. For example, 100.1 leverage means with $1 of your money, you can control $100 of currency. In practice, if you have $1,000 in your account, 100.1 leverage would allow you to take a position size up to $100,000, which is one standard lot. The advantage of leverage is that it amplifies your buying power. You can potentially make more money with a small account. The danger is that it also amplifies losses. It's often said, leverage is a double-edged sword. It can boost your gains or cut you down with equal force. Think of leverage like a lever used to lift a heavy object. With a long enough lever, you can lift a car with relatively little force. But if that lever slips, the car can crash down with the same magnified force. In trading terms, leverage allows you to control a large amount of money with a small deposit margin. For instance, as shown above, with 100.1 leverage, a $1,000 margin can control a $100,000 position. If that $100,000 position moves plus or 1%, which is 100 pips on a USD-based pair, it's a $1,000 gain, a 100% return on your $1,000. But if it moves 1%, that's a $1,000 loss, 100% of your deposit gone. Without leverage, a 1% move would only change the value of your investment by 1%. This is why leverage must be used carefully. It's enticing to have, say, 500.1 leverage and open huge trades, but doing so can wipe out an account quickly on a small adverse move. Many seasoned traders recommend beginners start with low effective leverage, like using 5-1 or 10-1 of what's available, until they thoroughly understand risk management. Margin. Margin goes hand in hand with leverage. Margin is the amount of your money that the broker sets aside as a good faith deposit to keep a trade open. It's usually expressed as a percentage of the full position size. For instance, if a broker requires 1% margin and you want to open a $100,000 position, you must have $1,000 as margin, which corresponds to 100.1 leverage. Margin is not a fee or a cost. It's still your money, but it's locked up while the trade is active to ensure you can cover potential losses. As you use more of your available margin, open more or larger positions, your margin level changes, which you monitor via the margin level % in your trading platform. Free margin is the money in your account not currently tied up in margin for open trades. This is what you have left to open new trades or to absorb losses. Used margin is the total currently allocated to keep positions open. Maintaining adequate free margin is important because of the next term, margin call. Margin call. A margin call happens when your account equity, your balance plus minus current profit loss, falls below a threshold set by the broker, typically a percentage of the required margin. In simpler terms, if your open trades are losing so much money that what's left of your account can no longer support those trades, the broker will take action. Initially, you might get a warning or margin call notification asking you to deposit more funds or close some positions. If losses continue and equity drops further to the stop-out level, the broker will start closing your positions automatically to prevent you from going negative. For example, if you have $1,000 and open trades requiring $500 margin, and those trades lose $800, bringing equity to $200, which is below the $500 margin requirement, the broker will close some or all positions. Stop loss and take profit orders. While not explicitly requested in the outline, it's worth mentioning as a key risk management tool. A stop loss, SL order, is a preset instruction to close a trade if price reaches a certain level against you, to cap your loss on that trade. For instance, if you buy EUR USD at 1.1000, you might set a stop loss at 1.0950, 50 pips risk. If EUR USD falls to 1.0950, the trade is closed, limiting the loss. A take profit TP does the opposite, automatically closes the trade at a target price in your favor to lock in profit. Using SL and TP orders helps impose discipline, especially important in volatile markets. Beginners should always consider using a stop loss, as it protects you from catastrophic loss if the market moves sharply against you while you aren't watching. Slippage. Slippage refers to the situation where your trade is executed at a slightly different price than you expected or requested. This often occurs in very fast-moving markets or low liquidity moments. For example, you have a stop loss at 1.2000 on a buy trade, but a major news release causes EUR USD to drop instantly from 1.2010 to 1.1980. Your stop might get filled at 1.1980 instead of 1.2000 because there were no buyers at 1.2000 in that sudden drop. Positive slippage can also happen, where you get a better price, but usually traders worry about negative slippage that increases a loss or reduces a profit. Slippage is most common during big economic news, like central bank decisions, employment reports, or market gaps, such as weekend gaps when the Monday opening price is far from Friday's close. To reduce slippage, you can avoid trading exactly during news spikes, use limit orders, which won't execute unless your exact price is available, or trade during high liquidity periods. However, some slippage is a normal part of trading. It's the trade-off for a market that doesn't guarantee fixed prices at every moment. Depiction. In the image above, the trader intended to enter or exit at the expected price, but the trade actually executed at a less favorable actual price, with the difference marked as slippage. Remember, slippage isn't due to broker malice with reputable brokers. It's simply market mechanics. Your order gets the next best available price if the market moves too quickly. New traders should be aware that slippage can occur, especially in Forex, where events can cause rapid moves. Proper position sizing and avoiding overtrading around major news can help mitigate the impact of slippage on your account. Swap rates, overnight interest. When you hold a Forex trade past the end of the trading day, typically defined as 5 p.m. New York time in Forex, you'll often earn or pay a small interest. This is called a swap or rollover fee. It happens because when you trade currencies, you are essentially long one currency and short another. Each currency has an interest rate set by its central bank. If the interest rate of the currency you bought is higher than that of the one you sold, you earn interest, a positive swap, for holding the position overnight. If vice versa, you pay interest, negative swap. For example, suppose you go long AUD JPY, buy Australian dollars, sell Japanese yen. If Australia's interest rates are, say, 4% and Japan's are 0%, you might earn a small daily interest for holding that trade. This is called a positive carry. However, if you were short AUD JPY, meaning you're effectively holding JPY and short AUD, you'd pay interest each day. In the diagram above, imagine currency A has 5% interest and currency B has 2%. If you are long A short B, you might earn roughly the 3% difference, annualized, divided by 365 for daily payout. If you reverse the trade, you'd pay that difference. Swap rates also depend on broker adjustments and can change day to day. Usually, brokers will clearly show the swap rates for buying or selling each pair. It's a small factor for short-term traders, a few days. But if you hold trades for weeks, swaps add up. Some strategies, like carry trading, specifically try to capture positive swaps by holding high-yielding currencies against low-yielding ones. But keep in mind, exchange rate movements usually have a far larger impact than interest rate differences. As a beginner, just be aware that you may see a tiny charge or credit in your account for positions held overnight. Also note, on Wednesdays, swap is often tripled to account for weekend interest in advance, since Forex doesn't settle on weekends. So don't be surprised by a larger swap charge credit midweek. Those are the key concepts you'll encounter from day one of Forex trading. Next, let's discuss how to choose a broker and what to consider when starting out. Not all Forex brokers are created equal, and as a beginner, picking a reliable, well-suited broker is important for your success and safety. Here are factors to consider. 1. Regulation and safety. Ensure the broker is properly regulated by a reputable authority in your region, for example, FCA in the UK, CISEC in Europe, CFTC, NFA in the US, ASIC in Australia, etc. Regulation provides a level of safety. It means the broker must follow certain rules, like segregating client funds from their own and maintaining sufficient capital. Avoid unregulated or sketchy offshore brokers that promise ridiculous leverage or bonuses. Your funds might not be safe there. Check reviews and community feedback as well. A well-known and long-established broker is generally a safer bet. 2. Trading platform. Most brokers offer platforms like MetaTrader 4, MT4, MetaTrader 5, MT5, MetaTrader 6, MT7, MT8, MT9, MT10, MT11, MT12, MT13, MT14, MT15, MT16, MT17, MT18, MT19, MT20, MT21, MT22, MT23, MT24, MT25, MT26, MT27, MT28, MT29, MT30, MT31, MT32, MT33, MT34, MT35, MT36, MT37, MT38, MT39, MT40, MT41, MT42, MT43, MT44, MT45, MT46, MT47, MT48, MT49, MT50, MT51, MT52, MT53, MT54, MT55, MT56, MT57, MT58, MT59, MT60, MT61, MT62, MT63, MT64, MT65, MT66, MT67, MT68, MT69, MT70, MT71, MT72, MT73, MT74, MT75, MT76, MT77, MT78, MT79, MT80, MT81, MT82, MT83, MT84, MT85, MT86, MT87, MT88, MT89, MT90, MT91, MT92, MT93, MT94 or their own proprietary platforms. MT4, MT5 are popular and have lots of support, tools, and the ability to use automated strategies. Ensure the platform is user-friendly, stable, and available on the devices you plan to use: desktop, web, mobile. As a beginner with a dark mode slide deck style in mind, you might appreciate a platform with clear charts and perhaps a dark theme for late-night trading. 3. Spreads and fees. As discussed, lower spreads save you money. Some brokers offer commission-free accounts with slightly higher spreads. Others offer raw spreads plus a commission. For beginners, a simple account with all costs in the spread is easiest to understand. Compare typical spreads on major pairs. Also check other fees, withdrawals, inactivity fees, etc. Many good brokers have no deposit withdrawal fees and no sneaky charges. 4. Leverage and margin requirements. Brokers will specify how much leverage they offer. Depending on where you live, regulation might cap this. E.g., in the EU, retail forex leverage is capped at 31. In the US, 50.1 on majors. While high leverage, like 501, might sound attractive, remember it should be used with caution. That said, having the flexibility of higher leverage can be useful as long as you manage position sizes wisely. Ensure you understand the broker's margin call and stop out levels too, e.g., margin call at 100% margin level, stop out at 50%. 5. Range of markets. If you only plan to trade major currency pairs, any forex broker will offer those. But many brokers also let you trade other assets via CFDs, contracts for difference, such as gold, oil, stock indices, individual stocks, crypto, etc. As a new trader, it's wise to focus on a few major forex pairs first. They're enough to learn and practice. However, choosing a broker that offers diverse instruments gives you room to explore down the road. For instance, you might start with EUR/USD, but later get interested in trading gold or the S&P 500 index. A multi-asset broker will allow that in the same account. 6. Customer support. Good customer service is invaluable, especially when you're starting out. Look for brokers that offer 24/5 or 24/7 support via live chat, phone, or email. Prompt and helpful support can assist if you encounter any platform issues, have questions about your account, or need guidance. Some brokers even offer support in multiple languages, including Ukrainian, which could be useful given your location. Chernivtsi, UA. 7. Education and tools. Some brokers shine in providing educational resources, webinars, tutorials, market analysis, demo contests, etc. Since you're learning, a broker that offers quality educational content for free is a plus. For example, many brokers have free weekly webinars on trading basics or strategy sessions. A demo account is essential. Ensure the broker offers a free demo account with virtual money so you can practice without risk. Virtually all do, but the quality of the demo environment can vary. Ideally, it should have real-time prices and not expire quickly. 8. Deposits and withdrawals. Check what payment methods are available: bank transfer, credit card, e-wallets, etc., and how fast withdrawals are processed. A reputable broker will process withdrawals in a reasonable time, 1 to 3 days for example, and won't make you jump through hoops to get your money. Also consider the minimum deposit. Some brokers let you start with as little as $5 or $50, which can be good for a beginner account. Though remember, a very small account will face limitations in position sizing and risk management. 9. Broker. Type. There are market makers and ECN STP brokers. Market makers internally match or take the other side of client trades. ECN STP brokers typically send your orders to the broader market, liquidity providers. There's a lot of debate on which is better. For beginners, the main concern is to have a broker that executes orders reliably with minimal requotes and slippage. Many good brokers operate hybrid models. As long as the broker is well regulated and well reviewed, you need not worry too much about this initially. 10. Reputation and reviews. Do some research on the broker's reputation. Forex forums and reviews can highlight any consistent issues, like withdrawal problems, platform outages, etc. Keep in mind every broker will have some negative reviews, often from traders who lost money, so look for patterns or serious red flags. Example: XM Broker Affiliate Mention. One broker that ticks many of these boxes, especially for beginners, is XM Broker. XM is a globally recognized Forex broker, founded in 2009, and offers services suitable for novice traders. They are well regulated, with entities under SISEC, ASIC, and others, provide a wide range of educational resources and webinars, 24-hour customer support, and allow a minimum deposit as low as $5. XM offers both standard accounts and micro accounts, which is great for new traders who want to trade small positions. They also have a demo account and support the popular MT4 so MT5 platforms. Many beginners appreciate XM's extensive library of tutorials and the fact that the platform environment is user-friendly. This is a soft recommendation. Of course, you should choose a broker that best fits your needs and local regulations. But the bottom line is, do your homework on brokers before depositing real money. A good broker will be a partner in your trading journey, while a bad one could cause unnecessary hurdles. Forex trading has a relatively low barrier to entry, which is a double-edged sword. Many beginners dive in before fully understanding the risks. Here are some common mistakes that novice Forex traders should avoid. 1. Over-leveraging and risking. Too much? This is arguably the #1 account killer. New traders often get tempted by high leverage and take positions that are far too large for their account size. For example, with $500 in account, someone might open a one-lot position because the broker allows it. A 50-pip adverse move could wipe them out. Solution: use low leverage initially. A good rule of thumb is risk no more than 1 to 2% of your account on a single trade. That means position sizing such that if your stop loss is hit, you only lose 1 to 2% of capital. This might sound small, but it ensures you live to trade another day. Slow and steady growth beats boom and bust. 2. No stop loss, no plan. Trading without a stop loss is like driving without a seatbelt. Perhaps you enter a trade thinking you'll manually exit if it goes bad. But what if price drops like a rock while you're distracted or asleep? Many beginners also lack a clear trading plan or strategy. They enter trades on hunches or tips. Solution: always set a stop loss when you open a trade. Determine in advance how much you're willing to lose if wrong. Also, try to have a basic strategy or criteria for entries and exits, even if it's as simple as following a trend or reacting to certain news. Discipline is key. One common piece of wisdom: plan the trade and trade the plan. Don't make impulsive changes mid-trade based on emotion. 3. Chasing the market and overtrading. The Forex market moves constantly, and a beginner can feel compelled to always be in a trade, or jump into a moving trend late out of fear of missing out, FOMO. This can lead to buying right at the top or selling at the bottom. Overtrading, taking too many trades, especially without rationale, often leads to losses and high transaction costs. Solution: be patient. It's perfectly fine, even smart, to sit on the sidelines until a clear opportunity arises. Quality over quantity. If you just closed a trade, especially a losing one, avoid the urge to immediately get revenge on the market with another trade, a phenomenon known as revenge trading. Take a deep breath, step back if needed, and stick to your strategy. 4. Letting losers run and cutting winners short. Emotionally, it's tough to accept a loss, so beginners often move or remove stop losses and let a losing trade keep sinking, hoping it will come back. Conversely, seeing a little profit triggers fear of losing it, so they close winners too early. This results in a scenario where one big loss wipes out many small gains. Solution: Stick to your predefined stop loss. If it hits, it hits. It means that trade thesis was wrong. Accept it and move on. For winning trades, consider using a take profit or trailing stop to lock in gains and aim for a reasonable reward to risk ratio, e.g., target at least 1.5 or 2 times your risk. The saying, cut your losses short, let your winners run, is easier said than done, but it's a crucial mindset. Don't let hope and fear dictate your decisions. Let your plan do that. 5. Ignoring economic calendar and news. Many beginners are caught off guard by scheduled news releases, like GDP reports, employment data, central bank meetings, that can cause volatility. For instance, you might be happily in a EUR USD trade, and suddenly it swings wildly because the European Central Bank made an announcement. Solution: always be aware of the economic calendar. Many free resources and broker sites provide a schedule of major upcoming news and their expected impact. If you're not prepared to handle high volatility, it may be wise to close trades or avoid trading during major news events. At the very least, use stop losses in case of big moves. Over time, you'll learn which events tend to move which currencies. 6. Lack of education and practice. Some people start trading real money without even knowing what a pip or margin call is, often ending in confusion and losses. Solution: take time to educate yourself, which you're doing right now. Complete a beginner course, like the popular free School of Pipsology or broker educational courses. Use demo accounts extensively to practice executing trades, applying stop losses, etc., in real market conditions but without risk. Treat the demo seriously. Only transition to live trading when you can at least trade break-even on demo consistently. Remember, there's no rush. The Forex market isn't going anywhere. It's better to start small and ramp up as your skill and confidence grow. 7. Emotional trading. Greed and fear. Human psychology can be an enemy in trading. Greed might make you double down on a risky trade or risk too much to chase big profits. Fear might make you exit winners too soon or avoid taking a good trade due to past losses. There's also the issue of stress and lack of sleep. Some beginners try to trade 24/5, not resting properly, which leads to mistakes. Solution: develop emotional awareness. If you just had a big loss, you might be emotionally compromised. Step away for a bit. Set realistic goals. Don't expect to turn $100 into $10,000 in a month. That's unrealistic and pushes you to gamble. Some traders keep a journal to note their feelings during trades and learn from mistakes. Always ensure you're well rested and not forcing trades out of boredom or desperation. 8. Following blindly and scam signals. Unfortunately, the trading world is rife with get-rich-quick schemes, signal sellers, and social media gurus flaunting unrealistic returns. Beginners sometimes buy expensive Forex robots or subscribe to signals hoping for easy money, only to get burned. Solution: be very skeptical of anyone promising guaranteed profits or very high win rates. If it sounds too good to be true, it likely is. While learning from others is good, ultimately you should understand why you are taking a trade. Try to build your own knowledge and not depend entirely on tips. If you do copy or follow someone, ensure they have a verified track record and risk management in place. And never pay large sums for secret strategies or bots without thorough research. Most can't live up to the hype. By being aware of these common pitfalls, you can consciously strive to avoid them. Trading is a skill that takes time to develop. Mistakes will happen, we all hit the wrong button or misread the chart at times. But the goal is to manage risk, so no single mistake is fatal to your account. Forex trading can be an exciting and rewarding endeavor. But as we've covered, it requires knowledge, discipline, and respect for the risks involved. Let's recap the key points from this beginner's guide. Forex 101. It's the world's largest market, trading currencies in pairs 24/7. You now know what it means to trade one currency for another and how exchange rates represent that relationship. We discussed how global events and economic factors can move currencies, sometimes dramatically. Recall that as of 2025, the market is hitting record volumes, nearly $10 trillion daily, partly due to volatility from things like trade policies and interest rate shifts. Key concepts. You learned about pips, the small price increments, lots, standardized trade sizes, spreads, transaction cost differences between bid and ask, and how leverage and margin allow traders to control large positions with little capital, while also posing significant risk if not managed properly. We illustrated margin calls and why you want to avoid them, and explained slippage in fast markets. You also got a handle on swap rates, the overnight interest that can be either a small bonus or cost, depending on the currency's interest rates. Practical aspects. We went through what to consider when choosing a broker, from regulation and spreads to platform and support. The example of XM Broker showed what a beginner-friendly broker might offer, such as extensive education and responsive service. The right broker provides a safe and supportive environment for you to learn and trade. Beginner mistakes. We highlighted common traps like over-leveraging, not using stop losses, trading on emotions, and falling for scams. Being aware of these can save you a lot of money and frustration. Remember, preservation of capital is priority one in the beginning. It's better to miss a trade than to blow up your account. The markets aren't going to disappear. There will always be another opportunity, so you don't need to chase every single move. Now, where should you go from here? 1. Start with a demo account. If you haven't already, open a demo trading account on a platform like MT4/MT5 with a broker of your choice. Practice executing the basics, placing market orders, setting stop loss and take profit, seeing how margin and PL move as trades fluctuate. Treat it seriously. Pretend the virtual money is real so that you cultivate good habits. 2. Develop a simple strategy. It could be as straightforward as trading in the direction of the trend on a daily chart, or buying when a certain support level holds. It doesn't need to be fancy. As you practice, you'll learn what works for you and what time frames or currency pairs you prefer. Keep a journal of your trades and outcomes. 3. Learn continuously. The Forex landscape in 2025 and beyond will keep evolving. New geopolitical events, changes in global economics, for example, changes in central bank policies, or perhaps new currencies emerging. Stay curious and keep learning. There are many free resources: Baby Pip School, broker webinars, YouTube tutorials, forums like Forex Factory, etc. Over time, you might explore technical analysis, charts, indicators, and fundamental analysis, economic news, to refine your approach. 4. Risk management is your friend. Always plan how much you'll risk. A common guideline: never risk more than 1 to 2% of your account on one trade. This might seem small, but it prevents wipeouts. Also, consider the worst-case scenarios. What if several trades hit stop loss in a row? Plan for it. This way, trading becomes sustainable. 5. Gradual transition to live trading. Once you're consistently doing well on demo for a few months, you could start with a small live account. Even $100 or $500. Trade micro lots to get the feel of real money emotions, which can be slightly different due to the psychological aspect. Treat that small account as tuition. The goal isn't to get rich off it, but to train yourself. If you make mistakes, it's okay. Better on a small scale than large. 6. Leverage wisely. Just because your broker offers 500.1 leverage doesn't mean you should use it fully. High leverage is there to give you flexibility and lower margin requirements, not to encourage maxing out your account on one trade. Many successful traders operate with much lower effective leverage. It only takes 1 or 2 bad leveraged bets to undo dozens of good ones if you're not careful. 7. Keep emotions in check. Develop routines that help keep you calm and objective. Some traders do a brief analysis in the morning, set alerts or orders, then walk away until conditions trigger. Others practice meditation or exercise to manage stress. Do what works for you. Remember that losses are part of the game. Even the best traders have losing trades regularly. The difference is they manage those losses and stick to their plan. 8. Connect with community. Selective. Engaging with other traders through forums, social media, or local trading groups can be helpful for learning and support, but be cautious of the blind leading the blind. It's good to discuss ideas, just ensure you're not being swayed into trades that you don't understand. Ultimately, it's your money on the line, so you decide. As a final thought, always keep your expectations realistic. Forex trading is not a get-rich-quick scheme. It's more like building any professional skill. It takes study, practice, and perseverance. There will be ups and downs. The goal for a beginner is not to make a fortune overnight, but to gradually build competence and consistency. Even a modest, steady return, or even just breaking even while learning, is a good first milestone. Protect your capital, aim to make more pips than you lose, and you'll be on the right path. If you feel ready to embark on your Forex trading journey, start by applying what you've learned here. Open a demo account, practice diligently, and continue expanding your knowledge. And when it comes time to go live, choose a reputable broker that supports your needs. For example, as mentioned, XM Broker is one option that offers a beginner-friendly environment, including a free demo, low minimum deposits, and plenty of educational materials. Using a trusted broker can give you peace of mind to focus on learning and trading. If you decide to check out XM, you can follow our affiliate link in the description. It's a way to support the channel at no extra cost to you, but feel no pressure. What matters most is you find the right fit for you. Thank you for watching and happy trading. Remember, every expert was once a beginner. Stay disciplined, keep learning, and over time you can become proficient in navigating the exciting Forex market. Good luck on your trading journey in 2025 and beyond.